All right, let's dive straight into this explainer. Imagine this. You're named America's most innovative company, 6 years in a row. You are on top of the world. And then you become the absolute poster child for corporate fraud. Today, we're unpacking one of the most stunning, dramatic, and honestly consequential stories in modern business history. We're talking about the monumental rise and ultimate catastrophic collapse of Enron. It's a story of blind ambition, brilliant illusions, and a complete failure of basic ethics.
So that brings us to the core mystery we're unpacking today. How exactly does a company go from being universally admired to a complete and utter symbol of fraud? I mean, think about it for a second. Enron wasn't just doing well, it was trusted by major investors, praised by Wall Street analysts, and literally celebrated by business magazines as the future of business. They spoke this compelling language of innovation, deregulation, and transformation. But as we're going to see, there is a massive, dangerous difference between building actual sustainable value and just managing the appearance of success.
Because to the outside world, Enron looked like an absolute rocket ship. A dynamic, wildly profitable, unstoppable force trading electricity and broadband. They were hailed as the smartest guys in the room. But behind closed doors, a totally different reality. We're talking mounting, unmanageable debt, ruthlessly manipulated financial statements, and a deeply toxic corporate culture. Executives were getting huge payouts for creating short-term illusions instead of long-term stability. The desperate need to maintain that glittering public image just completely overrode any sense of ethical accountability.
Part 1. The Facade. Governance and Accounting Failures.
Now, an illusion of this magnitude doesn't just happen by accident, right? It requires a total systemic breakdown. In theory, corporate governance is there to protect shareholders and the public. A strong board of directors should be interrogating the strategy, not just rubber stamping it. But Enron's board fundamentally failed to push back. They let highly unusual financial structures slide without asking the hard questions. Where is this revenue actually coming from? Are we creating real value, or are we just manufacturing it? A perfect example of this unchecked complexity was their use of special purpose entities, or SPEs. Normally, these can actually be legitimate business tools, but at Enron, they were completely weaponized. They used them specifically to construct a massive facade. By shifting their liabilities into these SPEs, Enron could hide crushing amounts of debt and keep incredibly serious risks totally off their main balance sheet. They essentially tricked investors by making the company look infinitely healthier than it really was.
The actual mechanics of how they pulled this off are just absolutely astounding. Enron used aggressive accounting practices that let them book expected future profits immediately, like before they'd even seen a single dime of actual cash. Imagine signing a 20-year energy contract and just boom, recording all 20 years of projected profit that very same day. So on paper, the illusion was that they were highly profitable and growing at an unprecedented rate. But in reality, the truth was they were weak, heavily indebted, and built on an incredibly fragile foundation of false confidence. And this isn't just some boring technical accounting issue. When financial reporting becomes this deliberately misleading, it destroys the foundational trust of the entire market.
Part 2. The Rot: Culture, Leadership, and Ethical Blindness.
You know, this whole deception wasn't just about manipulating numbers on a spreadsheet. It was deeply rooted in the company's psychology and an aggressively toxic culture. Enron was famous for its intense, ruthless performance pressure and incredible leadership overconfidence. They generously rewarded high performers, but look at the behavior they were actually incentivizing: deal-making at all costs, aggressive corporate growth, and claiming massive short-term profits. And worse, there was this strict expectation of blind loyalty to whatever narrative leadership was spinning, combined with extreme internal competition. If you missed your targets, you were gone. When you create an environment where employees feel they have to deliver spectacular results at any cost, and where questioning the boss is a career death sentence, bad news gets hidden, corners get cut. Basic honesty, transparency, and collaboration were just totally ignored in favor of pure survival and massive bonuses.
It perfectly captures this essential truth. Culture isn't what you print on a corporate values poster in the break room. Culture is what you actually reward people for doing. Enron's leadership suffered from total ethical blindness. They became so hyper-focused on success, status, and enormous personal payouts that they completely stopped recognizing the moral consequences of the systems they were building. They weren't just making poor strategic choices, they were actively engineering an environment designed to systematically mislead everyone. The warning signs were everywhere, absolutely everywhere. But the culture demanded that everyone keep their eyes wide shut.
Part 3. The Collapse: External Failures and the Human Cost.
Because, look, a company doesn't operate in a vacuum. The climax of our story arrives when this fragile foundation finally shatters. And when it did, it didn't just expose the internal rot at Enron.
It exposed a massive systemic failure of the external watchdogs who were supposed to be protecting the public. We're talking auditors, analysts, banks, regulators. They all failed to sound the alarm. Why? Because their independence was dangerously compromised. When your watchdogs are raking in massive consulting fees from the very clients they're supposed to be auditing, professional judgment goes right out the window. The exact people paid to provide independent checks and balances were financially incentivized to just look the other way. The entire system of corporate accountability collapsed right alongside the company.
I really want to pause here for a second and emphasize this specific number: thousands. It's so easy to talk about Enron strictly as a corporate fraud case, a complex financial puzzle to be solved. But ethical failure is never just abstract. Behind the sensational news headlines were thousands of ordinary employees who lost their jobs literally overnight. And worse, many of them lost their entire life savings because their retirement funds were heavily tied up in Enron stock. And the really bitter irony here? While senior executives were quietly cashing out millions of dollars in shares and getting top-tier legal advice, the rank-and-file employees were actually locked out of selling their own shares. They only saw the official optimistic company message. They believed the organization was strong until the very day it shattered. That is the devastating, very real human cost of this tragedy.
Part 4. The Moral: Lessons in Corporate Survival.
So what's the big takeaway? How do we stop this from ever happening again? We have to pull some hard-won, actionable wisdom from this disaster. The Enron story proves that corporate governance isn't just some boring bureaucratic checklist. It is the absolute bedrock of survival for any organization. Let's run through these essential lessons. Number 1, demand ultimate transparency. If stakeholders can't independently verify your information, your credibility is dead. Number 2, boards have to challenge complexity. If a business model is overly complex and impossible to explain simply, it needs more scrutiny, not less. Number 3, align reward incentives with actual ethics. If you prioritize massive short-term gains without robust ethical safeguards, misconduct is literally inevitable. People will do what you pay them to do. Number 4, foster a truth-telling culture. Employees need to be able to raise concerns and deliver bad news without the fear of retaliation. And number 5, maintain strict auditor independence. External assurance is entirely worthless if the watchdogs have a conflict of interest. Those lines have to remain clear.
Which leaves us with one incredibly important final thought. A company can survive a bad product launch, right? It can survive tough competition, even massive market downturns. But can it survive when trust is systematically destroyed from the inside out? The answer, as Enron tragically proved to the entire world, is a definitive no. Reputation might take decades of hard work to build, but it takes only days to completely collapse when ethics fail. Governance is not just a decoration for the annual report, and transparency isn't just a PR exercise. They are the fundamental foundation of survival. Thank you so much for joining me for this explainer, and I hope it gives you a powerful new perspective on exactly why the truth in business truly matters.